Hello and good morning. I welcome you to the morning meeting today on Monday, the 8th of January 2018. This is Jens Stolz speaking and exclusively presenting this format to you here for JFD Brokers as their global head of research and education. We want to have a look at the developments, especially in the DAX. So you may recall that in the morning we had already 2 hours ago a short discussion around the DAX and potential developments here. You may remember, this is interesting. 1 second, please. Yeah, okay. That I said that on one hand, you should be really careful in terms of short engagement, since the overall mode is still bullish. And so every push here out of the open range on the downside should be considered a corrective move, which is some kind of, let's call it, necessary after this aggressive push higher starting from last week, Wednesday onwards. Probably you can already say that we started pushing higher here after the fake out below 12,800 points last week on Tuesday in the afternoon. But this aggressive push higher here, so it's more and more likely that the market will finally stabilize at an elevated level here and take a breath until we then finally see another leg higher up to the all-time highs around 13,500 points here. Nevertheless, the stabilization at an elevated level probably coincides here with the gap close of the gap which can be found here. So the market opened, the DAX opened higher and above the highs from last week on Friday. And that's one of the reasons why I said a push out of the open range on the downside from a risk reward perspective is probably not the most attractive setup you can find here. But considering long engagements, again 330 here long, with probably a push back towards 390, 13,400 points. Only problem here again is that the risk reward is not very attractive, and you can already see that obviously I'm not going long against this level expecting a significant push higher. Again, that's one reason here can be found in the fact that the market is very extended on the upside. And so with this in mind, I said that it's not unlikely probably, where it is to expect that the market will probably consolidate here at an elevated level with a choppy structure. And if there is a push higher, then it will take some time that the market will consolidate here. The same is true for potential corrective moves down. And there we have probably targets if we go below 13,280 points. Probably a push towards 13,100, 130 points here on the downside. And nevertheless, it takes some time until the market finally makes such a move here. It's interesting to note that here, EURUSD, for example, right here is now pulling back a little towards 120, but all in all, it seems as if we are about to see a corrective move here in EURUSD2, which will probably push us towards 119.50, probably a little lower than that, 19, probably 18.50. Depends a little on the dynamic here. I see EURUSD as long as we trade above 117, that's for sure. And such a corrective move here is probably one of the key reasons why you should expect the DAX to stabilize at a quite high and elevated level before probably making another leg lower and a corrective move, which pushes us then towards, let's say, 13,100, 130 points here. So that's one good reason here to be skeptical about a near-term sharp declines in the DAX, that the euro is about to probably see a more extended move on the downside. So let's come back here and regarding the euro USD, especially regarding USD. Let's come back to last Friday's non-farm payrolls report. So in fact, the numbers are disappointed. So it was just 148,000, even though all the other components came in as expected. So average hourly earnings, for example, month on month, that was 0.3%. We had employment rate here, unemployment rate at 4.1%, for example. So all these numbers came in as expected, and yeah, making it a mixed data set. So based on the fact that the US dollar has seen already some losses over the last weeks, obviously that the US dollar is probably about to see corrective move, since most of this mixed data set here around the NFPs was already priced in. And that makes it more likely that the US dollar probably can make back some of those losses here, which mainly were driven, by the way, from the euro. You remember that the euro makes 60% out of this basket here in the US dollar index future. And here you can see that the dollar can stabilize right now. Probably we're about to see such a pullback towards 92.50, 92.80 probably, which will, by the way, potentially coincide with Euro USD here pushing lower towards and below 120 and towards 119.50, probably 119. And again, such a move lower here, especially in the Euro USD, is likely to stabilize the DAX at an elevated level here, even though if the market Euro USD can find a potential long trigger here around 119.50 and take another stint higher from there. I'm not saying, by the way, that we are pushing towards 121. Probably that's a little too much then, but nevertheless, if we can find support here and the market pushes back towards and above 120 again, that could lead to a little more extended corrective move in the DAX then, which will hold us back from a near-term attack at the all-time highs, even though in my opinion, that's the only target right now we should look for in the DAX. It's definitely fair to state that this is a very, very strong move and shows that all in all, we are probably not yet done on the upside, but we are about to see first new highs here, even though it, on the other hand, depends somehow what the US equity markets will deliver. I mean, the Dow Jones takes off again. Let's be honest, I don't see it as a big surprise, because with volatility being so low as it is right now, with the VIX stabilizing below 9, for example, so the volatility, below 10, slightly above 9, the volatility index on the S&P suggests that all in all, there is no real reason seen from market participants that there's a near-term a corrective move here in the markets and shouldn't be expected. And yeah, so the Dow Jones does the only thing which which is expected to happen right now, just pushing higher. Even though we are still in a very, very elevated and very, very extended territory there on the upside. And there will be, and we're really sure about this, there will be a corrective move. We don't know when it will happen, but the thing is that if it happens, I see the market really pushing really strongly on the downside here. And such a move then is also something which could weigh more heavy on the DAX here and should be also taken into account. So right now, everything seems to be awesome. Everything seems to be fine and new all-time highs. It's just a matter of time to get to see those. But nevertheless, with the euro having a chance to stabilize around 120 and probably and more likely, to be honest, above that level. And rather sooner than later, expected push on the downside in US equity markets is something which is definitely something worth considering when looking at the DAX here. And even though so far everything looks great here too, and we are potentially about to see new all-time highs in the near term, it's not sad that this will be the real deal move, but it's more likely that the market will probably push to new all-time highs in the DAX here and then see a bigger correction from there. And that's something you always have to keep in mind. So adapt accordingly your trading strategies, respectively. Don't come up with setups which do not specify a clear stop loss here on the downside. Then let's have a look here at dollar Japanese yen. I think very interesting currency pair, even though the overall structure is not very attractive. We can stabilize above 112, yes. Nevertheless, this is something I presented already to the German audience. 1 second, please. I'll just look it up here. And then show you the chart. It's a very nice divergence between 2-year US Treasuries. Oh, by the way, that's how we can do this here. So the green line is dollar Japanese yen. The red line is 2-year yields on 2-year US 2-year US yields. Yes, and what we can see is that there is in fact a correlation, even though in the last years there has been some kind of a divergence all the time, and the interesting thing was that nevertheless those two finally found back together somewhere in the future, and based on that, I somehow have the feeling that this is a too extended move here in yields. This is the red line. 2-year yields are pushing aggressively higher. The 2-year, 10-year yield curve flattened below 50 basis points. If I remember that right, last week. This is a very strong indication that market participants are very skeptical about the near-term economic outlook here for the US. And if you take this into account, then I somehow doubt that the Fed can really act as restrictive as expected right now, or as communicated in their last statement in December. And with this in mind, I somehow see that this red line, 2-year yields here, can push more aggressively down. The thing is that this does not necessarily mean that dollar yen will crash here, even though it's definitely something worth considering that usually those two have a quite strong positive correlation, those two asset classes, yields and dollar Japanese yen. And what we can definitely see is that there is some weakness can be spotted here in dollar Japanese yen, meaning if 2-year yields here push lower, then this is probably also a good reason to expect dollar yen to push lower, even though in fact if I would pair trade those two assets here, I'd go dollar Japanese yen long while shorting yields respectively, going long 2-year T-notes here. Yeah, that way I'd trade this correlation and expectation that yields would probably push more aggressively lower, even though I'd nevertheless consider dollar Japanese yen to have some potential on the downside, then pushing below 112 and also pushing below 111, respectively 110 here towards this region around 107 in the near term. But this is also something which is mainly or should be expected when risk aversion picks up and risk aversion is hitting the markets then. And that's something, yes, so far we can't see. Else we wouldn't see what we get to see, especially in the Dow Jones US equity markets, what we get to see in the volatility index, the VIX on the S&P. Yeah, let's have a final look here at gold. I consider gold to be really interesting since it hasn't shown any signs of weakness, also not after the non-farm payrolls. I mean, it wasn't capable of putting seeing some momentum, taking on momentum here. That was yeah, to be honest, not to be expected, since the NFP still, even though they were mixed, was a good number or a good data set, and especially after the aggressive push higher here in gold over the last weeks. And so it's not unusual that gold stabilizes and not pushes higher, even though we have to say this is really strong. If you look at the current strength in the US dollar and really picking up against the euro, for example, that the stabilization here, usually that would indicate that gold should push lower towards 1,300, probably below that level, and it's not taking place, meaning somehow that gold seems to be really strong. And this is something we should definitely keep in mind, even though I'd like to repeat here that I definitely favor long engagements below 1,300 USD from a risk reward perspective. So a push below that level would be much appreciated, let's say. And I'd really like to see gold pushing towards 1,290, probably 1,285, and going gold long against this region, since my midterm outlook for gold is positive, and I consider gold to take off and then go towards 1,360 and also above that 1,400 USD per ounce here. And that's it from my end. So I wish you happy trading. Watch your subs and take care. Talk to you again tomorrow, 10:30 a.m. GMT. I definitely look forward to it. And that's it from my end. So have a nice day. Happy trading. See you and bye-bye.